concept of strong and weak highs and lows. And as we know, the higher time frame structure is in black. So here we have our strong protected swing highs, right? Because they have taken out these weak lows. And then looking at the lower time frame trend in blue, here you can see that we were clearly bearish, making lower lows and lower highs, meaning that these highs were strong. And we expect them to be protected. And then as you can see, as soon as we switch bullish here, right, we then expect price to remain bullish. So then when we get a break of structure here, this then becomes a strong protected low, okay? And we continue bullish, and then we would expect this strong low to hold. And then as soon as price breaks it, that expectation has failed, okay? So then this high becomes strong. Okay, so we want to obviously trade away from strong legs. So price pulls back, this high then gets respected. We then get another move to the downside, breaking structure, and then this high also becomes protected, so on and so forth. And then we just expect that to continue until that expectation fails, and then price switches bullish, okay, because we have taken out that strong protected high. We've now switched bullish, and then we would expect this trend to now continue bullish until that expectation fails again, so on and so forth, okay? So hopefully that all makes sense. Now, this little diagram here should nicely summarize what we've been through. So lower time frame price action forms higher time frame price action, which creates higher time frame runs, which are lower time frame trends. Right, so it's those higher time frame runs which are made up of lower time frame trends, which is the fractal nature and never-ending cycle of the market, as the same patterns repeat themselves over and over again. So what we're now going to do is expand on the idea of using primary timeframes in order to make your multi-timeframe analysis as mechanical as possible. Because if we are consistent with our approach, we should have consistent results. Okay, great. So what does this actually mean? Well, when you're analyzing the charts and, cycling through multiple timeframes, it's very easy to fall into the trap of utilizing various different timeframes at your disposal in the attempt to try and make something fit, to the point where you almost forcefully are creating a bias, right, that fits your own narrative. Now, if you've been trading for a while, you've probably fallen into this trap, like I certainly have in the past, where you end up almost becoming overwhelmed with all of these conflicting biases. So in order to give ourselves the best possible chance of achieving consistency, we need to be consistent with our actions and approach, meaning that when we are playing a game of random outcomes and probabilities, such as the world of trading, it is our job to be as consistent as possible with the few varying factors and actions that we can actually personally control. So by reducing the amount of timeframes that we analyze, we decrease the possibility of conflicting our biases, which increases our level of clarity and focus to limit the amount of varying factors and discretion from our trading, which then reduces the amount of decisions we have to make, right? So ideally, we want to be using 3 primary timeframes to help create our narrative, guide us through the day-to-day price action, so intraday, and timing our entries with as much precision as possible. So this can be broken down into a higher time frame, a medium time frame, and a lower time frame. So our higher time frame in this example could be, the daily or the 4-hour, and we'd use this for our overall narrative and higher time frame perspective. And then our medium time frame could be, the 4-hour or the 15-minute for our intra-session or intraday bias. And then our lower time frame might be the 15-minute, so the M15, or the 1 minute, which we would then use for timing our entries. Okay. Now it all depends on your personal style, your work constraints, and just how you want to trade the market, because some people might use the daily for their higher time frame, the 4-hour for their medium, and then enter on the M15. Others might use the 4-hour for their higher time frame direction, the M15 for their intraday kind of bias, and then the M1 to time their entries. Okay, so really it all depends on what works best for you. Now, if you're not already using this concept of having a few key timeframes for your analysis, I would highly recommend that you just have to think about what timeframes are going to work best for you and try to make your trading plan fit around your current lifestyle and not the other way around. If you're someone that has a really busy work schedule, don't try and enter on the 1 minute. You need to probably take a little bit more of that longer term approach, just so that it doesn't conflict with your current circumstances. Okay, so have a think about which timeframes that you want to use and try and stick to just the 3, just so that you have a very mechanical approach to your analysis and timeframes. Okay, so what we're now going to do is introduce actual timeframes just for the purpose of the next few examples. However, this is not timeframe specific. Okay, so this could literally be applicable to any example, providing you have, a higher time frame, a medium time frame, and a lower time frame to work with. So here again, our higher time frame being the black line. Let's imagine it's now the daily. So again, we can see that the daily time frame is clearly bearish, making lower lows and lower highs. And then we have our medium time frame, which is the blue line. And let's call that the 4 hour. Okay, so as we know, within this one daily impulsive bearish run to the downside, we have the 4 hour time frame, which is making a series of lower lows and lower highs. So let me just mark that in blue. So we now have the 4 hour, which is making a series of lower lows and lower highs, which make up that one bearish daily run to the downside. Okay. And then, as we know, once the 4 hour time frame switches bullish, we know that that is our signal that the daily pullback is now starting. Okay, and then we can just follow these bullish ranges on the 4 hour until that expectation fails. Now, as you can see here, price pulls back, okay, into that strong protected low. We then get another push to the upside, breaking structure. So this then becomes our new higher low, our new strong protected low. Price pulls back, we have a movement up, but it fails to take out that weak 4 hour high. And then, as you can see, price then switches bearish, taking out that strong protected low. Okay, so our 4 hour range at this point, let me just get rid of all of these drawings. Our 4 hour low is here and our 4 hour high is here. Okay, so that's our 4 hour swing range. And then, as you can see, we have a movement up, price pulls back, it fails to put in a new higher high, and then we switch bearish. Okay, so once the 4 hour time frame has switched bearish, the 4 hour is now aligned with the daily, and that signals to us that the daily lower high is potentially forming and the swing pullback has now finished. Now, of course, we have our lower time frame being the 15 minute, the M15. So within these 4 hour bearish runs, right? We have a bearish run to the downside. We have a counter trend pullback on the 4 hour. We then have another impulsive leg to the downside. We then have another 4 hour pullback. We have another impulsive leg to the downside. Okay, so that's the 4 hour. Now, within those 4 hour runs, you can see that the 15 minute, being our lower time frame, was in fact creating a series of lower lows and lower highs, right? So as you can see, the market's just fractal. The lower you go, you're going to see the same patterns over and over again. So here, the M15 is making a series of lower lows and lower highs within that one 4 hour bearish run to the downside. So once the M15 switches bullish like that, and we take out that strong protected high on the M15, that's our signal that the 4 hour pullback is now starting. Okay, so now we can look to catch these M15 higher lows, right? And then when the M15 switches bearish, so let me just draw that again. When the M15 switches bearish over here, that's our signal that the 4 hour lower high is now forming and the 4 hour pullback has finished. And then we would just expect the M15 to remain bearish, right? Which is obviously that full-blown trend within that one 4 hour bearish run to the downside. And then once the M15 switches bullish again and price takes out that strong protected M15 high, we then expect the M15 to stay bullish until that expectation fails. And then the M15 switches bearish, which then confirms to us that the 4 hour pullback has now finished, so on and so forth, right? And literally we can go through this whole price model here, but I'm conscious of your time. So if you want to take it one step further, you can see that we also have the 1 minute time frame here as well. So I'll just go through this one last time. The 4-hour time frame switches bearish, which then confirms the daily swing pullback is over. Then the M15, as you can see here in orange, switches bullish to facilitate this 4-hour pullback. Now, if we wanted to try and catch the very start of this 4-hour lower high, what we could do is jump into the 1 minute, okay? Because as we know, the market's a fractal. So what we're now going to do is just look at this price model up here. So as we can see in orange, the M15 is bullish, okay? Making higher highs and higher lows to facilitate the 4-hour swing pullback in blue. Now, of course, the 1 minute time frame is going to first have to switch bearish to facilitate the M15 pullback, okay? So hopefully you could see with this black dotted line, that being the 1 minute time frame. So let me just mark this out in black. So the 1 minute makes a series of higher highs and higher lows, which make up that one impulsive leg on the M15. Now, what can we do to anticipate when that M15 is going to start pulling back? Well, of course, what we can do is hop into the 1 minute and wait for it to shift bullish. So as you can see, the 1 minute is clearly bullish, making a series of higher highs and higher lows. So it's making a full-blown trend within that one impulsive leg on the M15. So how can we anticipate when the M15 is going to start pulling back? Well, of course, we can look at the 1 minute. So when the 1 minute shifts bearish and we get a 1 minute breaker structure, that's a signal that potentially the M15 pullback is now starting, right? So then the 1 minute shifts bearish to facilitate that M15 pullback. Then it shifts bullish, right? Which signals to us that potentially the M15 pullback is now finishing. Okay, so if we wanted to try and catch the very start of this 4-hour lower high here, we can obviously look at the 1 minute time frame. Let me just mark this out in black again. So here, the 1 minute time frame is making higher highs and higher lows. The 1 minute time frame then shifts bearish. So if we want to try and anticipate to catch this 4-hour lower high, we can jump into the 1 minute. We can wait for the 1 minute to then shift bearish, okay, which is then catching potentially the start of that M15 pullback. But as you can see, the 1 minute time frame remains bearish that whole time. We then switch bearish on the M15 as well. So now we have positioned ourselves, in the very, very start of potentially this next 4-hour impulsive leg to the downside. And we've caught the very, very start of that lower high. Now, of course, that is quite aggressive, because you're using the 1 minute time frame to anticipate a higher time frame turning point in the market. But this is what you can do once you start to understand other confluences such as supply and demand, liquidity, premium versus discount, and all of that good stuff. But really, once you understand the fractal nature of the market and the relationship between different timeframes, this is how you can catch the very start of those higher timeframe turning points within the market, okay? Now, we've just got a little bit more theory to go through, and then we will jump on the charts and we will have a look at some live price action, and we'll also have a look at some trade examples as well. So what I want you to imagine is that this is the daily time frame here like that. So we have a daily impulsive run to the downside. We then have a daily corrective pullback, and we are expecting another daily impulsive leg to the downside, okay? Now, for the daily to pull back, the 4-hour time frame is likely going to have to switch bullish to facilitate that daily pullback, okay? So what I want you to visualize is that the next piece of price action that we're going to have a look at is the 4-hour pullback. Now, because the 4-hour time frame is bullish, this low here is what? It's strong, it's protected, so we expect it to hold, right? Now, of course, the overall picture is that the daily is bearish, so we have to manage our expectations that this low could also fail, because if price is pulled back to an area of value on the daily time frame, then it's likely the daily is going to switch bearish, right? But we just run with the expectation that structure is going to hold until it fails. So because this low here took out that high and the 4-hour time frame is bullish, we would expect price to come down here. We would expect this strong low to hold, and we would expect the 4-hour time frame to at least continue bullish. But as I say, we have to be aware of the overall bigger picture, and the daily time frame is bearish. So we are expecting a daily lower high to then take out this daily low here, right, which I haven't actually drawn on, but imagine that's the daily low forming to facilitate that pullback, right? So hopefully that's all clear.